Hello, welcome to Investor Insights. I'm Chloe Cho. The bulls are back in control with equities, bonds, and gold all rallying. All of this exuberance makes us wonder whether an inflection point is just around the corner. Here's a look at our headlines.
Wall Street trades at all-time highs as a strong U.S. jobs number fades out Brexit worries, but corporate America readies for its fifth straight quarter of earnings decline. It's the first policy decision from the Bank of England since the Brexit outcome. Will Mark Carney announce a 25 basis point cut and kickstart monetary easing?
We wouldn't represent this as a single silver bullet. It is part and should be seen as part of a series of measures.
Plus, Trading Talents Asia Pacific unveils the top 8 this week as 3 more are eliminated in the third finals week of the region's first televised trading challenge. Let's get insights from Nicholas Ferris, Investment Director, Eastspring Investments, Nicholas Wilcox, Executive Director, JP Morgan Asset Management European Equity Group, Mitchell Kotecha, Head of Asia Pacific FX Rates and Strategy, Barclays, and our judges of Trading Talents Asia Pacific, Eric Liu, Head of Research, Vonda Research, and Jeremy Raper, founder of Raper Capital Management. A strong beat in U.S. jobs has unleashed confidence in a market unsettled by Brexit. Non-farm payrolls in June skyrocketed to 287,000, the biggest monthly jobs gain in 8 months, and marked a sharp reversal from May's big miss. Equities remain well supported with the S&P 500 in record territory, and so are long-dated U.S. Treasuries with both the 10s and 30s yielding new lows. Gold continues to be in demand, setting a 2-year winning streak, up nearly 30% this year on Brexit uncertainties and scaled back expectations of the Fed's rate hike trajectory.
Why we're seeing this renewed appetite for gold is really the fact that we are seeing a negative interest rate environment. We're seeing sovereign debt yields continue to plummet around the world. An increased amount is now trading negative. And that's basically led to create a big challenge for investment managers around the world. So we are seeing real money moving back into gold at this stage. And as long as that trend continues, gold will continue to be supported, and we'll see that the dips in the market will be bought into.
Wall Street is eyeing earnings this week, with second quarter profit expected to drop 4.7%, marking the 5th straight quarter of declines, a slight improvement from the previous quarter's 5% tumble. Any upbeat surprise from the financials such as BlackRock, JP Morgan, Wells Fargo, and Citigroup throughout this week should result in a scramble among investors, given expectations for another weak quarter of a 7.95% earnings drop. However, the biggest drag is likely to come from the energy sector amid projections for an 80% decline. Crude prices have also been struggling despite a drop in U.S. oil production as output from OPEC, Russia, and Canada remains elevated.
Following the Brexit, we have seen some concerns about demand growth in the Far East, especially from China and India. China has been a very strong buyer of oil so far this year, but refineries there as well are starting to run out of capacity for all the gasoline and diesel they produced. And while we see this glut being reduced, oil price upsides will remain limited. So even if we should see some additional QE, this will not have a major impact on oil. The main impact through QE could be the movements of the dollar. If we do see the dollar start strengthening further, then that could have a negative impact.
Who would have known that 2 weeks after the shock outcome of Brexit that the strategy would have been to buy everything, maybe except for oil? Is an inflection point at bay? Let's talk more with Nicholas Ferris, Investment Director, Eastspring Investments, and Nicholas Wilcox, Executive Director of JP Morgan Asset Management's European Equity Group. Gentlemen, so we have 2 Nicholases right here on the show. Welcome. Great to have you with us. So, it's absolutely bizarre, this strange exuberance by gold, by equities, by bonds. Is there any reason to believe that maybe even the U.S. earnings season might surprise us and this risk momentum keeps on going?
Well, actually, Chloe, I think what we're seeing is actually the opposite of exuberance. It's actually been motivated by fear, not greed. So the outperformance of bonds in particular, and then bond-like equity, utilities and consumer staples, has actually been very much a defensive-led rally.
Given that everything has become so expensive, what do you buy?
Yes, bonds are expensive, but not cyclicals. Cyclicals, in fact, are trading at probably their biggest discount since 1999 in relative price terms and almost in valuation terms. So actually, the way we've been positioning our portfolio is to buy European equities. We're overweight European equities, Italian equities, Austrian equities. On UK Independence Day, I bought FTSE 100.
You did very well. FTSE 100 is up 70% year to date.
That's
Sterling,
right.
hope you've hedged your currency.
Actually, I didn't. We took on sterling as well because sterling had fallen a lot. We did buy Japanese equities hedged though as well. So we've taken a more constructive view on cyclicals and value.
How critical are the problems in the Italian banking sector? Non-performing loans, 1/5 of the country's GDP, and in fact, the GDP itself has been downgraded by the IMF.
This isn't a new problem. This has been around for decades. The non-performing loans, as you say, are a large percentage of GDP. Estimates at the moment somewhere between 150 and maybe 200, 250 billion euros. So these are big numbers. But ultimately, they are being dealt with. The European Banking Union has undergone these numerous stress tests. We saw the initial outcome of these back in 2014. The next tranche is coming through as we speak, which is what's brought this to light. But I think we are nearing the end of this story rather than at the beginning, and I think we will see some sort of resolution.
As negotiations continue between Brussels and Italy, ultimately it comes down to what sort of conclusion they reach. Are they going to do a bail-in? Are they going to do a bail-out? As Matteo Renzi stakes his political career in October, is there any chance that the banking woes of Italy will actually turn into a seismic and even systemic problem?
Potentially, but I think you need to remember that the Italian referendum in October is very different from what we've just seen in the UK. This isn't an in-out vote for Europe. This is Renzi trying to essentially shore up the Italian political system. And as such, yes, we might see a little bit of movement around the margin. And remember that the Italian banking system, the problem that Renzi has right now is that there are a lot of retail, essentially deposit holders, who were rightly or wrongly moved into junior debt, and so they potentially are the ones that will lose out if we see a bail-in. And yes, that might have ramifications come October's referendum, but it's certainly not as extreme a vote, or the implications of the vote are certainly not as extreme as we've seen in the UK in recent weeks.
So given the huge sell-off that we've seen with the Italian banks, and you're buying them, is it because of the cheap valuation? You do believe there's going to be some political backstop?
We've got a position in Italian equities. We've had that for some time, and we've been increasing that more recently into the sell-off. Italian equities are trading at 0.7 times book value. Earnings are 40% below trend. So we think there's a significant upside if there's some sort of normalisation.
Yeah, but you've got to be able to sleep at night, right? But when all said and done, what about this risk of contagion across the pond? After all, we do have the U.S. earnings season kicking off, and it's probably not going to be pretty.
I think there has been some inflection in the leading indicators of earnings. So I look at the ISM index, the manufacturing survey, which does tend to sort of be a quite decent leading indicator of profits in the US, and there has been an inflection point there. I wouldn't be surprised if there's further weakness or downward revisions in bank sector earnings, for example. But again, the banking sector in the US is trading at a 60% discount to the broad US market. So I would actually look to take on US banks as well.
If there are any surprises or any sort of glimmer of hope, is this actually another trigger for more upside in this global equities rally?
This is a move from extreme pessimism to a slightly less bad situation, and as such, any small incremental improvement in the data is currently having quite a large impact. So you're absolutely right. If we see Q2 earnings not disappointing as significantly as people expect, we may see that as the next catalyst for the next leg up.
So Nicholas, both of you, thank you so much for that. Coming up, Trading Talents Asia Pacific. Let's check in with two of our judges, Eric Liu and Jeremy Raper. Welcome back. It is time for Trading Challenge Asia Pacific. Let's take a look at how our top 11 fared as they fought for a spot in top 8.
The top 11 may have come this far after battling out more than 2,000 trading enthusiasts from the start, but 3 are facing cuts this week in Asia Pacific's first televised trading challenge. As exuberance abounds with fears over Brexit fading into the background, how are the finalists tweaking their trading strategies?
The job reports didn't change our trading view substantially. We still favor commodity currencies against euro and cable, and meanwhile try to buy dollar yen on dips as long as the pair holds above 100.
After the US job, I think the best strategy is to buy the Hong Kong stock, the Hong Kong China Enterprise stock, because I think the stock is still about 15% year-to-date down compared to the Dow Jones 4%.
Bank of England may pull off a surprise here and hold interest rate unchanged. If that happens, it could well be a catalyst for a major recovery for most of the power crosses.
Execution is key. Being on the wrong side of the trade could have easily wiped out the $10,000 balance in their live accounts with access to thousands of instruments from Forex, options, CFDs to futures. 3 finalists are eliminated this week based on the judging criteria of net portfolio value. Max Drawdown, Judges Scores, and Cloud Score now gauges their social media influence. Up for grabs, the grand prize of $30,000, another $10,000 for the runner-up, and $2,000 for the top weekly trader. Plus, 5 online voters voting for their favorite trading talent get to win $100 worth of e-vouchers each week.
If you get caught up on any kind of one trade or any kind of 1 week, you're just basically going to burn out. One has to be very cognizant of the amount of leverage that you're running at the moment.
It's very difficult to make money when everyone's moving in the same direction.
If you want to be able to sleep at night, you have to hedge your long book somehow.
Trading Challenge Asia Pacific is already on its halfway mark, and top 11 will become top 8 this week. So 3 eliminations. Let's check in with our judges. Eric Liu of Vonda Research is back with us. Plus, say hello to Jeremy Raper, founder of Raper Capital Management. So gentlemen, great to see you. What a fascinating week. We just talked about this exuberance/fear in the market. We have the top 3. We have Richard, we have Rahul, and Boon Sang. Was there a common denominator in your view that got them in this position? Eric?
I actually don't think there was. I think they had quite varied investment strategies, and so you'll see Richard and Raul had very tight stop losses, great risk management. They were able to cut trades very quickly. On the other hand, Boon Sang is effectively an investor in this sort of competition. The average duration of trades is more like 2 days. His win rate, so the percentage of trades that he's gotten correct, is near 75%, which is phenomenal on any sort of platform.
Right.
So he's been holding trades. He knows the trade that he likes. He knows the instruments that he likes.
It's interesting how he's playing the spread between the A50 in China and the Hang Seng Enterprises Index. I mean, how do you do that after a beat in U.S. jobs? How do you translate that into China?
Translating all this volatility into specific trading strategies, especially a spread trade strategy where you buy or sell HSCI versus A50. You can translate it to a risk-on or a risk-off strategies.
And what's the strategy with stop losses? Because the general rule is that it's a ratio of 2 to 1, but when you actually look at the top contenders in this competition, not really the case. They are keeping them very, very tight.
Competitors are very tactical and they're smart. They understand how the competition is played. They understand that we're looking at weekly numbers, and in general, the competition itself isn't very long. So you could be right, or in the long run, your position could be right, or it could turn the right way. But if the cutoff date doesn't allow that money to be realized, then it doesn't make a difference.
Typical stop loss rules, 2 to 1, 3 to 1, what have you, they may not always apply. In a mean reversion type environment, that may be in the case. What we've actually seen post-Brexit is much more of a trend. So just touching on Richard, things he's done very well throughout the competition. He's only made money 40% of his trades, so quite different to what we were talking about with Boon. But he's nevertheless up over 40% net over the competition, 3 weeks thus far. So you know, he's been very, very disciplined in cutting what's not working.
Let's pick up on Kelvin Chong, KL-based. What is not working in your view?
Well, he's not one for lack of preparation, that's for sure. Unfortunately, you know, you can do all the work, and if your view is wrong, or if your timing is a little bit off, you know, you can really get carried out in markets such as this.
Here's a look at our winner of the week and our top 8.
The winner is...
Unfortunately, we've had to say goodbye to Pratan Cham of Thailand, Ho Lon Leng and Kai Yi Gan of Singapore.
Guys, thanks so much for that. Eric Liu of Vonda Research and Jeremy Raper of Raper Capital Management. And still to come, we're going to talk about FX strategy. And here's a look at our online poll.
What action will the Bank of England take on July 14th? Find out what our online poll revealed right after the break. Welcome back. What action will the Bank of England take on July 14th? The survey says...
There you go, and let's find out what Mito Kotecha, head of Asia Pacific Rates and FX Strategy of Barclays, think. So BOE, a big meeting, our online poll reveals probably a 25 basis point cut. What do you think?
Well, I mean, the market has moved along the line of your online poll in the sense that the market has largely priced in a rate cut at this meeting. However, we think the Bank of England will probably wait until they
Why wait?
Well, they'll probably want to see data in the aftermath of the Brexit vote. If anything, the data has already started to soften. We've seen some weakness in consumer confidence surveys, business surveys. But I think what they'll probably do is time this alongside the quarterly inflation report. They'll get a little bit more information, and then they can determine exactly how much of easing will need to be done. I mean, we think they could ease up to 50 basis points, add anywhere around 100 to 150 billion sterling in more QE as well. So there's certainly a lot in the pipeline for what the Bank of England will do, but perhaps not as early as this meeting. That doesn't mean you may not see one or two or even more Bank of England members vote for a rate cut, but we think they'll probably delay.
Is there a certain point for sterling to drop that actually causes capital outflows? I mean, it's already lost 20 cents since Brexit.
That's right. I mean, it clearly has weakened sharply, although we've seen a recovery over recent days. The reality is that sterling is going to continue to remain under pressure in our view. At what point does it result in significant outflows? Well, I think already we have seen some outflows. The problem for the UK is it has a current account deficit, so capital outflows means that it's more difficult to fund this deficit. Nonetheless, sterling is looking cheaper. There are a lot of investors who may look to invest in the UK as sterling cheapens further. So I don't think it's going to result in significant pressure in terms of outflows in the months ahead.
Is there a floor? I mean, people like Mohammed El Arian sees it as low as parity against the USD.
Yeah, I would be very surprised if we went anywhere near that low. I mean, I think we will see further declines, and certainly towards, towards 124, 125 looks quite reasonable. But I think, a lot of bad news has been priced. Yes, there will be more negative news on the economy. We'll probably see, as we mentioned, a bit more capital flight. But again, I don't think sterling is going to weaken as dramatically as we've been seeing. It'll probably be more of a steady grind lower in the coming weeks and months.
What about the Bank of Japan? We saw big swings in dollar yen in anticipation of this announcement. So far, hasn't been coming. How large is this fiscal stimulus package going to be? Some are saying as large as 10 to 20 trillion yen, which would be 2.5 to up to 5% of Japan's GDP.
There's obviously a big expectation now that something needs to be done in terms of fiscal stimulus alongside BOJ easing, which is likely at the end of this month as well. So we could see BOJ cut again the IOER, so more negative deposit rates, adding to also more easing in terms of ETF buying. So certainly more action both on the fiscal and monetary front, and that's why we've seen dollar yen also move higher in recent days.
If the BOJ makes a bold move, is there any reason to believe that this tight correlation that we've been seeing since mid-March or so between dollar-yen and the 10-year U.S. Treasury, that is going to break?
Well, I mean, I think if anything, our view is still that dollar-yen moves lower over the medium term. This move in dollar-yen at the moment is short-term. This bounce is likely ultimately to be sold into. But I think, again, it's on the expectation of stimulus of both from the BOJ and the government. And I think ultimately, once this happens, I think dollar-yen, the forces pushing dollar-yen lower, will continue to be in play.
Also interesting moves with the Chinese renminbi. Amidst all this talk about stimulus elsewhere around the world, we've seen some huge moves to the downside. It's down about 7%, 8% over a one-year horizon. On a trade-weighted basis, it's off much more than that, 12, 13%. And yet, why isn't it causing havoc as it did early this year or August? Or is it going to add another layer in a wobbly market environment?
Well, I think it's interesting that you say that. I think the reality is that China has communicated much, much more efficiently in terms of the FX weakness. A lot of investors now see the move in the currency as related to general dollar moves, because as you said, the basket itself is becoming a bigger focus. Yes, the currency basket, the trade-weighted basket is depreciating, but I think markets are just now much more accustomed to at least understanding how the dollar CNY is moving. We think it will continue to move on a weaker trajectory, the CNY, and our view is that the currency should depreciate several percent more in the coming months. But again,
any target?
Well, I mean, I think at least a move through 7, if not beyond that, on dollar CNY in the next several months.
Oh, excellent stuff. Always great to talk to you.
Thank you.
Mito Kotecha of Barclays. And let's take a look at our question of the week.
Before we go, here is our question of the week. How long will this rally in stocks, bonds, and gold last? Tweet me at Chloe Cho TV or email us at investorinsights@mediacorp.com.sg.
And that's our show for this week. And remember to tune in next week as Trading Talents Asia Pacific reveals top 6. You certainly don't want to miss that. I'm Chloe Cho, and have a fantastic week.